Open your brokerage app right now. Curious. Gold is sitting at 5,210. Silver is at 86.40. And if you have been watching that number today, you have watched something happen that the financial media is already in the process of explaining to you incorrectly. Sarcastic. They are going to blame geopolitical noise. They are going to reference yield curve movement. They are going to frame today's price action as a consolidation pattern and tell you that disciplined investors are reducing exposure ahead of the next Fed communication window. They are going to deliver that explanation with complete confidence. They are going to have the charts ready. They are going to have the credentialed voices ready, and every single sentence of that explanation is going to be engineered to produce exactly one outcome inside the mind of every retail participant who consumes it: hesitation, doubt, inaction. I want to intercept that narrative before it settles into your decision-making framework, because while that story is being packaged for public distribution, something was quietly released inside the research infrastructure of one of the most powerful financial institutions on Earth that completely contradicts every word of what you are about to hear on television. JPMorgan's Commodities Research Division released a comprehensive internal research brief today, not a press release, not a headline summary, a full institutional analysis written for clients who manage capital at a scale where a single reallocation decision can move hundreds of millions of dollars in a single session. And that brief does not say what the financial news cycle is telling you right now. It says the opposite. It confirms that the structural foundation for silver is not eroding. It is compounding. It confirms that the price you are looking at on your screen today is not a reflection of where this metal stands in the assessment of institutions that have access to the actual supply-demand data, the actual reserve flow data, and the actual forward industrial consumption modeling that retail participants are never shown. There is a gap between what the paper price is communicating and what JPMorgan is telling its largest clients in private research channels, and that gap is the only number that matters today. I am going to show you exactly how wide that gap is. I am going to walk you through what the JPMorgan brief actually contains. I am going to show you the hidden supply constraint nobody in mainstream financial media is connecting to this price action, and I am going to show you the mechanical reason why what happened today is not what it looks like without this context. When this video ends, you will understand why today was not a warning signal. It was an entry window, and entry windows created by mechanical leverage flushes do not stay open indefinitely. Here is the architecture of what is actually happening. The mainstream financial media operates on a narrative loop calibrated to the attention span of retail participants. Today, it takes yield movement and builds a complete explanatory framework around it. The narrative runs like this. Rising yield expectations reduce the attractiveness of non-yielding assets. Therefore, institutional capital rotates out of metals. Therefore, the drop in silver is a rational market response. That narrative is designed to feel complete, and it will produce exactly one response in retail participants who accept it: the belief that reducing exposure is the prudent thing to do right now. Meanwhile, in a completely separate communication channel, JPMorgan is telling institutional clients that precious metals are entering a phase of structural repricing driven by forces that have no relationship to yield expectations or Fed commentary. Same market, same day. Two entirely different messages traveling to two entirely different audiences. The public gets the narrative that produces the price action the institutions need. The institutions get the research that explains why that price action is an opportunity. Before I take you through the brief, the standard note. I read institutional research, I track physical market data, and I translate what I find into plain language for people who are not being invited to the client meetings where this information is normally shared. Nothing I present here is a recommendation. What I present is the same analysis the institutions have, stripped of the language that keeps it inaccessible to retail participants. Now let me ask you something directly. When silver printed at 86.40 today, and the media narrative started assembling itself around the yield story, what was your immediate reaction? Did the drop feel like fundamental deterioration? Or did it immediately read as a mechanical paper market event with no connection to physical supply-demand reality? Drop your honest answer in the comments right now. It tells you which framework is running in your decision-making process. Now let us talk about what the JPMorgan brief actually says. Silver delivered 148% through 2025. Gold crossed $5,000 per ounce before its recent consolidation. Silver volatility is up over 100% year-to-date. Gold volatility up 46%. Their characterization of this environment? Structural. Their characterization of the current price level? Disconnected from the forward demand picture that physical consumption data is already confirming. They identify three catalysts: Three structural forces that tell billion-dollar clients today's paper price action is a temporary mechanical dislocation, not a fundamental signal. None of them are technical. None of them are seasonal. None of them depend on any single policy decision. They are structural, long duration, and accelerating simultaneously. Catalyst 1. Sovereign debt spiral. Global sovereign debt has crossed the threshold into structural arithmetic that has only ever resolved one way historically. The United States is carrying federal debt above 120% of gross domestic product, with annual deficits running at 6 to 7% of GDP. And JPMorgan confirms this is synchronized across every major developed economy simultaneously: the United Kingdom, France, Japan, Canada. The debt saturation is systemic. Here is the operational detail that matters. An increasing share of new debt being issued is not funding productive investment. It is funding the interest cost on debt issued previously. The government is borrowing money to make payments on money it already borrowed. That is the mechanical definition of a debt spiral. Once a sovereign debt spiral reaches this scale, the resolution pathways compress to three options: explicit default, debt restructuring, or currency devaluation through sustained inflation. Democratic governments holding reserve currency status do not choose explicit default. What remains is the slow, then accelerating erosion of purchasing power through monetary expansion. JPMorgan confirms gold has historically been the primary beneficiary of sovereign debt-driven currency erosion, and silver has functioned as a higher volatility extension of that dynamic. The debt-driven store of value case and the industrial demand case are both strengthening simultaneously, and the price has not begun to reflect the convergence of those two forces. Catalyst 2. Central bank reserve recomposition. Central banks collectively hold approximately 20% of all gold ever mined, and have been systematically adding to those holdings for 3 years in a coordinated move designed to reduce exposure to dollar-denominated reserve assets. In 2025, gold surpassed U.S. Treasuries as the largest single asset category in global sovereign reserves for the first time in 30 years. Read that again. The asset sovereign monetary institutions now trust more than U.S. government debt to hold national wealth is gold. And the buying is not plateauing. 52% of central banks were buying in 2021, 81% in 2024. Today, 95% of central banks report expecting global gold reserves to increase further through 2026. The momentum is compounding quarter over quarter. JPMorgan then identifies the specific forward demand pressure that makes this the beginning of a much larger move. China and Brazil, two of the largest economies on Earth, both currently hold less than 10% of their reserves in gold. The global average is approximately 20%. If those reserve allocations move even toward the global average, the incremental demand against finite physical supply is a structural pricing event, not a trading move, a structural repricing. When central banks make a coordinated decision to exit a reserve asset, they are making a formal judgment about the long-duration reliability of the monetary system behind it. The official announcement of a monetary system failure always comes last. It comes after the institutional repositioning is substantially complete. The period between the repositioning and the announcement is where the wealth transfer occurs. JPMorgan believes their institutional clients are inside that window right now. Catalyst 3. Irreplaceable industrial demand. Today, 60% of total annual silver consumption is tied to electronics, solar photovoltaic technology, and semiconductor manufacturing. That is not investment demand. That is not speculative positioning. That is industrial consumption, tied to infrastructure build cycles with committed capital behind them, and no substitution alternative available at scale. Electronics manufacturing alone accounts for approximately 445 million ounces of silver consumption per year, the single largest industrial application of the metal on Earth, and that is the baseline before AI infrastructure demand is added. Solar photovoltaic technology accounted for nearly 29% of total silver industrial demand in 2024. In 2014, that same category represented approximately 11%. A near tripling of solar's share of total silver consumption in a single decade, driven by technology that every major economy is now deploying at mandated scale. There is no synthetic substitute for silver in photovoltaic manufacturing that performs the same function at the required conductivity and cost level. The electrification of the global economy is a committed infrastructure trajectory backed by sovereign mandates and private capital that is years into execution and decades from completion. JPMorgan's conclusion on industrial demand is direct. Silver's structural role in enabling the electrification and digitization of the global economy will produce a permanently elevated industrial consumption floor that does not soften when economic conditions moderate. Industrial demand is rising permanently. New mine supply cannot scale to match it. The paper price at 86.40 has not begun to reflect the demand curve already documented in the consumption data. Now let me consolidate those three catalysts because the convergence is what makes this moment different from every previous dip in this cycle. Electronics, solar, and semiconductors consuming 445 million ounces annually before AI acceleration. Solar demand nearly tripling its consumption share in a single decade with mandatory deployment still in early stage execution. Central banks with 95% indicating they will continue accumulating through 2026. China and Brazil still below 10% reserve allocation with rebalancing underway. Private wealth allocations to gold running 50% below levels from a decade ago. Gold exchange traded products holding over 4,000 tons globally with assets exceeding $650 billion and inflows accelerating, and an entirely new category of structural buyer from the stablecoin ecosystem. The stablecoin market expanded from $28 billion in 2020 to over $280 billion in 2025. Conservative projections put it at $1.9 trillion by 2030. Even fractional allocation of that capital into gold-backed instruments creates incremental demand against finite supply that is a structural pricing event. Every variable is moving in a direction that reduces available physical supply relative to forward demand. But today, something additional is forming beneath the yield story that nobody in mainstream financial media is connecting to this metal. The private credit market has expanded to over $1 trillion in committed capital deployed into borrowers that regulated banks declined because their risk profiles exceeded conventional lending standards. That decision was calibrated for a specific rate environment and growth trajectory. Neither of those conditions currently exists. With rates elevated and momentum softening, the debt serviceability of private credit borrowers is deteriorating. And critically, the losses building inside private credit vehicles are not visible in real time because these positions are not marked to market. The impairment is accumulating inside balance sheets of hedge funds, pension funds, insurance companies, and sovereign wealth funds that purchased private credit exposure as a yield enhancement strategy. When those losses surface, the forced deleveraging will move through financial markets in ways conventional risk models are not designed to contain. JPMorgan's brief answers this with historical performance data. Since 2020, during months when the S&P 500 declined more than 5%, gold delivered an average positive return of approximately 2%. The U.S. aggregate bond index returned essentially flat during those same periods. The conventional diversification tool provided no protection exactly when it was most needed. Physical metal carries no counterparty risk. It cannot be inflated away. It carries no default exposure. It is the only major asset class satisfying all three characteristics simultaneously. And the institutions reading the JPMorgan brief are positioning for the private credit shock scenario now, inside the same window that opens every time paper price is temporarily disconnected from physical reality by a leverage cascade. Here is the technical mechanism that explains today's silver price action precisely. A leveraged futures participant on the COMEX carries a margin requirement that is a fraction of total contract value. When price declines below the level exhausting the margin buffer, the broker issues a margin call. If the participant cannot fund it immediately, the position is liquidated automatically at the prevailing market price. That forced liquidation creates additional sell pressure. Additional sell pressure drops the price further. Further decline triggers the next tier of leveraged positions. Those are liquidated. The cascade continues until every over-leveraged position has been mechanically flushed. This is not organic selling from participants who changed their conviction on the metal. Physical holders have no margin calls. They are not leveraged. They do not sell into a paper price cascade. The selling comes exclusively from the leveraged paper market, and the buyers absorbing every forced sale at temporarily suppressed prices are the institutional participants who know the paper price produced by the flush does not reflect what physical metal actually clears at. The physical market confirms this directly. If silver were genuinely losing fundamental support, physical premiums at retail dealers would be collapsing. You would see physical silver available at or near paper spot. That is not what is happening. Premiums on silver eagles, silver maples, and generic rounds are holding. Physical holders have assessed the same structural framework JPMorgan is documenting and concluded the case for holding the metal is stronger than the signal being produced by a short-duration paper cascade. Physical holders have no margin calls, no algorithmic stop losses. They hold. And because they hold, Available physical supply does not increase regardless of what the paper price displays. Any buyer needing actual delivery has to pay a premium above the suppressed paper price to find a willing seller. That spread between paper price and physical premium is the physical market's real-time verdict on the credibility of the paper signal. Let me place this in historical context precisely. Every significant monetary transition in recorded history follows an identical sequence. Institutions with sovereign-grade information identify the structural shift before it becomes publicly legible. They position into assets that retain value through the transition. The public, receiving information through media ecosystems those same institutions influence, interprets short-cycle price volatility as evidence of weakness rather than accumulation. The public reduces exposure. The institutions accumulate from them at prices that will look extraordinary in retrospect. The transition becomes undeniable. The price reflects the new monetary reality. The people who exited during the accumulation window are on the outside looking at a price level that no longer offers the entry the paper cascade briefly created. That is not a theory. It is the documented and repeatable result of information asymmetry operating during structural regime transitions. And it is the precise sequence JPMorgan's research brief is describing for clients who have the capital and conviction to position for it. Today, silver is at 86.40. Silver rose 148% through 2025. Central banks are accumulating at the fastest documented pace in a generation. Industrial demand is consuming 60% of annual supply before any AI premium is applied. Private wealth remains 50% underallocated relative to its own historical baseline. And a new structural buyer from the stablecoin ecosystem has entered this market at a scale with no precedent in any previous metals cycle. The paper price today is the only variable in that list that has not confirmed the thesis. Every other data point has. Either the paper price is correctly signaling something that JPMorgan's institutional research, sovereign reserve data, physical market premiums, and industrial consumption modeling are all getting wrong. Or the paper price is the final variable, the last to catch up to a structural reality every other data source is already registering. That is a framework decision, a decision about which source of information you trust to reflect where this metal is actually going. If this analysis gave you a clearer picture of what today represents, do one thing right now: subscribe. Because I am tracking JPMorgan's ETF flow data, COMEX registered inventory levels, the physical premium spread, central bank reserve reporting, and private credit market stress signals in real time. Every significant development comes to this channel before it hits the mainstream press and before the price has already moved. Share this with one person in your network currently reading today's drop as a fundamental signal rather than a mechanical leverage event, because they deserve to see what JPMorgan is telling institutional clients before they make an irreversible decision based on a yield headline. And drop in the comments which variable you are watching most closely: the central bank rebalancing pace, the private credit stress signals, the physical premium spread, the stablecoin to gold flow. I want to know where your attention is this week. Here is what I am watching. Physical premiums at retail and wholesale. If they hold or expand while paper price sits in this range, physical holders are not responding to the paper mechanism. Central bank reserve data. Next quarterly reporting will show whether accumulation accelerated through the first quarter of 2026. Acceleration means the sovereign demand signal intensified heading into the second half of the year. Private credit default events. Watch for hedge fund redemption gates, forced liquidation announcements, or visible impairment from private credit vehicles. At $1.8 trillion in total exposure, the scale of potential forced rotation into physical assets is significant. COMEX registered inventory levels. If metal eligible for delivery continues declining while open interest holds or expands, the mechanical preconditions for a physical delivery squeeze are forming. And stablecoin growth with gold-backed instrument development. If that $280 billion market migrates even partially toward gold collateralized instruments, the incremental demand is a structural pricing event. Watch those 5 variables. Not the daily paper price, not the yield data, not the Fed commentary. Those 5 will tell you what is happening before the paper price confirms it. JPMorgan just put the framework in writing for the wealthiest clients in the world. The central banks are accumulating with 95% indicating they will continue through 2026. Industrial demand is non-negotiable and rising from a baseline of 60% of annual supply already consumed. The private credit risk is real and building in silence. Private wealth is 50% below its own decade-old baseline. and the paper price at 86.40 is lagging every other variable simultaneously. Today was not the end of anything. Today was the setup. I will see you in the next one.